We found an unusual trade on DocuSign stock, ticker symbol DOCU. And what's very unusual about this trade is that DocuSign reports earnings today, September 5th, after the market closes. And so in this video, we will analyze this unusual option activity to find out how this wealthy investor is trading DocuSign for earnings. Are they bullish and buying or bearish and selling? So that we can also trade in the same direction to make money while the rich are getting richer on Wall Street. Because as we all know, the rich have more access to information, sometimes leaked insider information, such as earnings reports, to make better financial decisions. No wonder the rich get richer. And after our analysis, we will show our trading strategy based on this wealthy investor's trade. So without further ado, let's dive into the data as usual. As we can see here on the options time and sales tape, at about 1:29 at the 3-second mark, these September 6 options at the 59 strike calls and the 62 strike calls were being traded as a spread. And you can see here the price that they paid. And so we can do a quick calculation of the cost of each of their contracts. We have $194 for the 59 strike calls that they bought, and they sold the 62 strike calls for $87. So we subtract 87 to get a total trade cost of $107 per contract. And so how many contracts did they trade? Well, let's take a deeper look at the option chain. We can see here for the September 6 options, which expires tomorrow, okay, just one day. So these are definitely earnings trades. We can see here at the 59 strike calls, more than 3,000 contracts being traded. And at the 62 strike calls, more than 3,000 being traded as well. And both of these options are opening trades, since they are greater than the open interest of only 435 at the 59 strike calls and 229 at the 62 strike calls. And so if we were to estimate the total trade cost on this, because we know each of them costs $107, and there was at least 3,000 contracts, we multiply by 3,000 to get a total trade cost of about $321,000. So this is a lower probability of profit trade because it is higher risk, including the fact that today is earnings that increases the risk even more. So we use position sizing and trading strategies to manage our risk. If you are interested in the lower risk, higher probability of profit trades, then make sure to go to our website. We'll put a link at the top here where we share better trade ideas than this one here, because this has a higher chance of being a loss in comparison to the ones that we share on our website that have a higher chance of becoming a winner. Now you can see that when we analyze this trade where they are buying the 59 strike calls and selling the 62 strike calls, where we know they were buying them for 107 each, you can see that on the risk profile profit loss graph, that this is a vertical call spread strategy. And you can see that they are risking the 107, and that is why if the share price goes down, which is represented by the x-axis here, then this would be a complete loss of their trade. So they're risking 107 to potentially make at max profit $193. That's the blue line at expiration tomorrow. And so if we calculate the risk to reward ratio on this trade, 193 divided by the risk of 107, you can see that this is a 1.8 risk to reward ratio, meaning it could potentially make 180% profit. So the reward is in their favor in comparison to the risk. Now, we did not trade this strategy. We used another option strategy to trade this, not this one, because we have a better risk to reward ratio. And you can see here for our trade, our positions are over here. POS stands for position, green means buy, red means sell. However, we sold at a very different ratio than the amount of options that we bought. And what we mean by that is that at the 61 strike calls, we sold 2 of these for every one of the 62 strike calls that we bought and the 59 strike call that we bought. So you can see that we have a ratio here of a 1 to 2 to 1. This is known as a butterfly strategy. And so when we analyze our trading strategy, you can see here that each of our trades costs $48 of debit. And you can see that we are also risking $48. That's minus 48 if it goes down. If it goes up, you can see that at max profit, which is this blue line here, shows our profit here on this square. We have a max profit here of $140. Okay, and so this amount, you can see here, at $140 divided by the 48 risk is a risk reward ratio of 2.9, meaning we could potentially make 291% profit on this trade. So much more than the unusual option trade that was only at 180%. And so this reward is much more in our favor. And that is one of the reasons why we prefer this strategy, as well as other reasons such as the volatility crush that happens after earnings. You can see that our trade here, we have a vega of nearly 0 here. Okay, because we know after earnings, the volatility will drop. And that is not very good for certain option trades, like these unusual options here. You can see that their vega is a positive vega. And by having a positive vega, that is against the negative vega crush that will happen. So that's not very advantageous to earnings events, and that is why we prefer our butterfly strategy. If you want to learn more on how to trade options, or you want to gain access to better trade ideas, make sure to go to our website. Put a link at the top here. Again, this trade is very high risk because of earnings. It could potentially be a loss, but because we diversify our portfolio with better trade ideas that we share on our website, we still have more winners than we have losers. And when we do win, we gain a lot more profits than when we do lose. Let us know in the comments below what you think will happen to DocuSign. Do you think it will go up or down after earnings? As usual, please smash the like button, subscribe if you haven't. Take care and have a wonderful day.